This is ShadowQuant Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, July 21, 2026, and this is the New York session. Now, let's get into it. Good morning. We are tracking a distinct fracture in the U.S. equity complex as of 9:19 Eastern Time. The S&P 500 ETF, SPY, is holding at $742.09, essentially flat, while the Russell 2000 IWM has retreated 0.59% to $292.31, and healthcare, the healthcare sector, is shedding 1.14%. This isn't just noise. It's a divergence where mega-cap stability is masking significant structural weakness in small caps and defensible sectors. Let's look at what's driving this split. Before we dig into the charts, let's review the schedule. Today is Tuesday, July 21, 2026. The primary market mover is earnings. BlackRock, BLK, reports today with an estimated earnings per share of $12.49. We also have updates from Air Lease, ALK, Ally Financial, Ally, and AmerisourceBergen, AMSF. But the real weight rests on BLK, as it serves as the bellwether for the financial sector's health amid this rate environment. Apex, what is the single most critical variable to watch in that BLK report?
It's not just the beat or miss, it's the fee stream commentary. Given that the 10-year two-year yield curve is flattened at plus 0.39 pp and core PCE is stuck at 3.41%, BLK's ability to maintain margins against rising client redemption pressures is the litmus test. If BLK signals that asset gathering is stalling because clients are pulling cash into treasuries to capture that flat curve, it validates the stress we're seeing in the financial sector right now, which is down 0.39%.
Understood. So we're watching for liquidity stress indicators in financials. Let's move to the broader picture. SPY is at $742.09. Triple Q is up 0.1% to $696.06. But Diamonds is down 0.55% to $517.94. The market is being propped up by tech, while industrial and consumer cyclicals bleed. CIPHER, we saw Danaher, DHR, gap down 15% despite strong Q2 results. What does this sell the news event tell us about the current earnings landscape?
It tells us that the market's required return has shifted violently upward. DHR didn't fail operationally, they raised guidance. The 15% drop to $171.01 indicates that investors are no longer rewarding solid. They are demanding explosive growth to justify existing multiples. This is a repricing event. When you combine DHR's collapse with Agios Pharmaceuticals, Agio dropping 12.8% to $34.93 on trial results, it becomes clear that the risk premium in healthcare and life sciences has expanded dramatically. We aren't just seeing profit-taking, we see a structural derating of quality names.
So quality is no longer a shield. SPECTER, you've been flagging the macro risks. How does DHR's reaction tie into the yield curve and inflation data you cited earlier?
It's a direct consequence of the macro trap. We have a 10-year two-year spread of only plus 0.39 pp, a flat curve, and core PCE at 3.41%, well above the 2% target. Normally, a flat curve precedes recessionary signals, but the VIX is sitting calmly at 18.77. That calm is the danger. DHR's collapse proves that when inflation remains sticky at 3.41% and growth slows to 2.9% annualized, companies can't pass on costs, margins get crushed, and the market punishes them regardless of guidance. The VIX at 18.77 suggests complacency, but the price action in DHR and Agio suggests the floor is crumbling.
Let's talk about the technical structure holding this together or failing to. Grid, SPY is at $742.09. You noted earlier that it's hovering near its 5-day low of $740.80. Walk us through the support levels.
SPY is trading within 0.17% of that 5-day low. The buffer is non-existent. Looking at the 10-day range, which spans from $739.51 to $755.58, price is currently in the bottom quartile. There is no momentum here. If $740.80 gives way, the next immediate support is the lower bound of that 10-day channel at $739.51. There are no higher timeframe reversal patterns visible yet. We are simply grinding lower within a compression zone.
And for the smaller players, IWM is at $292.31, down 0.59%.
IWM is in a far worse technical posture. At $292.31, it is practically touching its 5-day low of $291.64, set on July 17. The 10-day range for IWM is $290.68 to $299.97. We are testing the absolute lower edge of recent trading. If $291.64 breaks, we expose $290.68. Unlike SPY, which has some artificial support from megacap weighting, IWM's breakdown is clean. It's a structural failure of the support level.
Pulse, how does the VIX at 18.77 reconcile with this technical breakdown in IWM and the sell-off in DHR? Should we be worried about a volatility spike? That is the crux of the issue. The VIX at 18.77 is suppressing fear disproportionately to the actual damage happening in IWM and the healthcare sector. Usually, when IWM drops nearly 0.6% and the healthcare sector sheds 1.14%, you'd expect the VIX to tick up significantly. Instead, it's barely moved, adding only 2.4 points. This indicates institutional complacency. They are ignoring the breadth failure. However, that low VIX is dangerous because it means positioning is still long gamma in the indices. When the inevitable trigger hits, likely IWM breaking $291.64, that complacency flips instantly to panic. The put/call ratios aren't screaming alarm yet, but the price action in DHR and Agio shows that retail and funds alike are getting burned trying to catch knives in healthcare. Let's shift to the sector rotation. We see the energy sector, energy, leading gains at plus 0.45%, while the healthcare sector, healthcare, is the laggard at minus 1.14%. CIPHER, what's happening in energy? We have Magnolia Oil and Gas, MGY, down 5.9% despite a $4.06 billion acquisition announcement. That seems counterintuitive.
It is an anomaly, but it reveals the underlying liquidity crunch. MGY is down to $24.03 despite a $4.6 billion accretive acquisition of Wildfire Energy. On the surface, this should be a pop. Instead, it's a drag. Why? Because capital is fleeing energy names due to macro headwinds, specifically the strong dollar. The trade-weighted dollar index is at 120.53, up 0.2% week over week. Multinational energy firms face translation headwinds. More importantly, the fact that MGY can drop on a massive M and a deal tells us that buyers are scarce. This contrasts sharply with the tech sector, where the technology sector is down 3.7% for the week, despite a tiny plus 0.7% daily gain. Liquidity is drying up everywhere, except in the very largest megacaps.
So in energy, even good news isn't enough to attract bids. Pulse, how is sentiment shifting in the consumer staples, which is down 0.39%? Staples are usually the final refuge, but consumer staples is declining. Combined with utilities, the utilities sector, down 1.71% for the week, we are seeing a flight to nowhere. Investors are exiting defensives, the healthcare sector, the utilities sector, consumer staples, not because they are confident in growth, but because they are trapped. They are waiting for a clearer signal before committing capital elsewhere. The sentiment score for defensive sectors is turning negative, not because of bad news, but because of the absence of a catalyst. With core PCE at 3.41%, there is no safe harbor that offers adequate yield protection against inflation erosion. Let's drill down into technology. the technology sector. It's showing a plus 0.7% gain today at $175.71, but it's down 3.7% for the week. Grid, is this technical strength or a lagging indicator?
It's a lagging indicator masking a breakdown. Triple Q, the proxy for the technology sector, is at $696.06. While it's holding above its 10-day low of $686.76, it has fallen from a recent high of $726.39. The daily plus 0.1% change is noise. Structurally, Triple Q is testing the lower boundary of its 10-day channel. If Triple Q loses $686.76, it confirms the breakdown of the uptrend. The plus 0.7% in the technology sector is purely intraday arbitrage. The weekly chart shows exhaustion. We are seeing profit-taking in tech because the risk-reward has worsened with the flat yield curve.
SPECTER, you mentioned earlier that tech is acting as a liquidity sink. Does that pose a risk to the broader market if that sink clogs?
Absolutely. The divergence you're seeing, SPY flat, Triple Q slightly up, but IWM down 0.59% and the healthcare sector down 1.14%, is unsustainable. The S&P 500 is being held up by the top 10 holdings. If NVDA or MSFT stumble, or if Triple Q breaks below $686.76, the algorithmic support vanishes. We are currently in a complacency trap, as Apex noted. The VIX at 18.77 is lying to us. It says risk is low, but the fact that a company like DHR can drop 15% on good news proves risk is mispriced. If the dollar strengthens further, impacting those multinational tech earnings, that sink becomes a drain, and the rotation into energy, the energy sector, is just a desperate search for yield in a broken system.
Let's look at financials again. The financial sector is down 0.39%. BlackRock, BLK, is our key catalyst today. Apex, how do you synthesize the BLK report with the technical fragility we've discussed?
Here is the synthesis. Grid flagged the SPY 5-day low at $740.80, but CIPHER showed us that DHR's collapse indicates a general derating of quality. If BLK, with its estimated $12.49 earnings per share, shows any sign of asset outflows or margin compression due to the flat yield curve, plus 0.39 pp, it will invalidate the SPY support. We cannot rely on SPY being stable when its components are riding. CIPHER highlighted that MGY dropped 5.9% on a $4.6 billion deal. Similarly, if BLK misses or guides conservatively, we won't just see a dip, we'll see a validation of the bearish thesis CIPHER laid out. The healthy consolidation Apex mentioned earlier is actually distribution, confirmed by the weak volume in IWM and the lack of participation in the healthcare sector.
Pulse, finalize the sentiment read on BLK. Are traders buying the rumor or selling the news here? Based on the DHR precedent, the bar is impossibly high. Traders are positioned for perfection, which means any deviation is a sale. The sentiment around BLK is fragile. With the VIX at 18.77, there is little hedging in place. If BLK is merely in line, the market may sell it due to the lack of upside surprise. We are seeing a no room for error environment across the board, from biotech Agio to industrials DHR, and now financials BLK. We have covered the major fractures. Let's summarize the key observations from today's pre-market session as of 9:19 Eastern Time. First, a sharp bifurcation exists. SPY holds at $742.09, while IWM falls to $292.31, revealing that megacap stability is hiding broad-based weakness. Second, the sell the news dynamic is dominant, evidenced by DHR's 15% drop and MGY's anomalous 5.9% decline, despite positive corporate actions, signaling that market participants are de-risking aggressively. Third, technical structures are fragile, with SPY testing its 5-day low of $740.80 and IWM perilously close to $291.64. Finally, the VIX at 18.77 suggests complacency that contradicts the worsening fundamentals, including a flat yield curve and sticky core PCE at 3.41%. Tomorrow, the focus remains on whether BLK can stabilize the financial sector narrative, or if the breakdown in IWM and the healthcare sector accelerates. This has been the Equities edition. Thank you for listening. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.